So as I was saying, you are welcome to today's lecture. We'll be looking at consolidated profit and loss basically today. In our earlier discussions, we looked at consolidated balance sheet. How do we consolidate two balance sheets of two or more entities? But we basically look at two entities. So after the consolidated profit and loss account, we will now look at how to do the consolidation for two or more, that is from three going. But basically, at your level here, you'll be looking at two entities for now. So we have looked at how to consolidate balance sheets. We are going to look at how to consolidate profit and loss account, or how do we consolidate the income statement of two separate entities. In an attempt to consolidate the profit and loss of two separate entities, the principle of control still holds. The principle of control still holds. So you must establish control before you consolidate. You must establish that there is a parent subsidiary relationship before you do consolidation, or before you go ahead and do the consolidation. And so therefore, if there is no parent subsidiary relationship, you can't go ahead and do the consolidation. We treat them in a different manner, and when we get there too, I'll show you how to do that particular one. But for now, where there is a parent subsidiary relationship, the account can be consolidated, and this is a format of how consolidated statement of profit and loss account also look at. Last semester, we got to know what we mean by turnover. When we say turnover, what do we mean? When we say turnover, what are we trying to say? So therefore, you will be given the two statements of profit and loss for two different companies, and you are going to be seeing their sales they make for the respective years or for the financial year in question, and you consolidate. And I told you consolidation is just a mere addition of two financial statements. But that does not mean that when they give you the two financial statements, you just add the two and then you say you have consolidated. There are certain principles that you follow. There are certain workings that you must do to establish certain figures before you do your consolidation. But in a nutshell, it is a line-by-line addition of the two financial statements. So the sales you are seeing here, or the turnover you are seeing here, we are assuming is the sales of A and B added together. The profit you are seeing here is the profit of A and B added together. The tax you are seeing here is the tax of A and B together. Then you have profit after tax, then you have your minority interest, and then what is left here is your group profit. So basically, when we talk about consolidation or consolidated profit and loss account, that is what it is. And it is the easiest. It is the easiest. You can consolidate profit and loss account under 1 minute. Under 1 minute. Under 1 minute. You see the question, and before 1 minute, you have consolidated the account. If you know what you are doing and you know the variables over there, less than 1 minute, you can consolidate this particular account. Are you getting the scenario? Then when you are done with the consolidated profit and loss account, the next thing you do is to consolidate the income surplus account to like that. So you prepare your consolidated income surplus for the two companies. So you have their retained profit brought forward. Then you add the profit for the year. Then you less dividends and transfers. And if you have any other transfers to bring them there. And then you have your retained earnings. You have your retained earnings. So this is the format you'll be following when it comes to consolidation or consolidating your profit and loss account. There are certain principles you should be able to identify, or there are certain things you should be able to take note of when it comes to the profit and loss account. When we were dealing with the balance sheet, we came across dividends, and then we also came across interest. We came across dividends, and then we came across what? Interest. Intra-group balances are eliminated when we were doing the balance sheet. I told you that intra-group balance sheets are eliminated. The same principle applies over here. So when we get to intra-group balances, where you have intra-group interest, intra-group dividends, you eliminate those ones. So anything coming from the subsidiary to the holding company must not be represented on the account. When you do that, you are overstating your profits. You are overstating your profits. And so therefore, you might be reporting wrongly to the shareholders. You might be reporting wrongly to the shareholders. So anything that is coming from the subsidiary to the holding company in terms of dividends and interest, dividends and interest, you must eliminate it. And so therefore, in the books of the subsidiary, you are going to see it dividend payable. And when you come to the holding company, you will see dividend received or dividend receivable. When you go to the subsidiary, you see it interest payable. When you come to this particular holding company, you see it as well, interest receivable or interest received. So these are some of the things your eye must be open on, or you must have a firm understanding on before you can successfully consolidate the account. The very first illustration I've posted on the page for you, on the platform for you, you can go there and then you have a look at it, but I can still go back here. This is the question I've posted on the platform for you. This particular illustration, example 9, is what I've sent on the platform for you. So those who are having their questions, this is the question. So you can screenshot, we don't have it. So this is the very first illustration we'll be looking at. The profit and loss account of H Limited and its subsidiary S Limited for the year ended 30th June 2013 is as follows. So you have the financial statement for H, and then you have the financial statement for X. Now, when you are about to consolidate the account, there are certain things you must take note of. Go to the additional information. We're told that debenture interest received by H includes 1,000 from X. So quickly, you go to H account, Where is the debenture interest received? This is the debenture interest received. And they said this interest of 2,000, 1,000 was coming from S. So you go to S, okay, S has paid debenture. S also say he paid debenture interest. So whatever debenture interest S has paid here, 1,000 is going to what? H, and S paid only 1,000. So this 1,000, 1,000 is here. So it means that when we are consolidating the account, this 1,000 will not come. 1,000 from here will also not come, or will also not appear on the face of the account. That is what I was explaining. Assuming the interest as paid is 5,000 over here, then it means that when we are consolidating the account, we will represent only 4,000 on the account over here. And here we represent only what? 1,000. We'll subtract 1,000 here, we subtract 1,000. That is what this statement here means. I get you the scenario. Good. Now, we are being told that H owns 80% of S. This is the statement you must see before you go ahead and consolidate. You must establish parent-subsidiary relationship. And once they told us that H is owning 80% of S, it is a clear indication that S is a subsidiary of H. So we can go ahead and do our consolidation. So let's go ahead and do the consolidation as the way we ought to do it. So let's go and look at our solution for this particular illustration. So let me zoom it small so that you can see. Good. So in the books of H, we have the sales in the question given to us. H sales given is 100,000 and S sales given is 60,000. So what we do here is to just do a mere addition of the sales, and then we get 160,000. Then we come to the cost of goods sold given. H is 50,000, S is 32,000. So you add the 50 and the 32, you get 82. So when I subtract my 82 from the 160,000, I'm going to get I'll get 78,000 as my gross profit. So my gross profit is 78,000. And then I come to my selling, general, and administration expenses. That of H is 20,000. That of S is 17,000. And so therefore, when I add the two, I will get 37,000. So 37,000 becomes my consolidated selling, general, administration expenses. So when I less it from the 78,000, I'll get 41,000. 41,000. Then I bring my other incomes. And you should know other incomes. Now, why am I bringing this particular one, the 41,000 here, is called your operating profits. Last semester, when we were looking at final account, I made mention of this, how to determine your operating profit. So if I subtracted my cost of sales from the sales, I get gross profit, and I less my selling general administration expenses for me. So let's say my selling and distribution expenses, my general administration expenses, I get operating profit. So these two expenses, when I less it from my gross profit, I get what you call what? Operating profit. My operating profit. Operating profit. Good. Then I come to other incomes, and this is where you must be vigilant. Note 1. We were told that the interest received by H includes 1,000 from S. So they are telling us that this 2,000 that is coming from H, 1,000 is coming from S. And so therefore, when I come here, that 2,000 of H, I'll subtract that 1,000 inside. What it means is that H has received a total interest of 2,000. 1,000 is coming from S. 1,000 is coming from elsewhere. That elsewhere, it's not your concern. You are not interested about that elsewhere. Who and who are we consolidating? I'm consolidating H and S. So what transpired between H and S is what I'm interested in. Whatever transpired between H and W or H and Q is not my problem. So this particular 1,000 here, whatever it is coming from, is not my problem. So this one will still be on the account. But this 1,000 that is coming from S amounted to an intragroup balance or intragroup transaction, which must be eliminated on the face of the account. I get in the scenario. Good. Then I come to my other expenses. They have not told me any notes concerning the other expenses. So my royalties of 4,000 still holds. My profits before taxation would be the 42,000 minus the 4,000. So this is my profit before tax. And when you see in some books, they will write it earnings before tax. This is it. They will say earnings before tax. EBT, earnings before tax. So those of you who will be upgrading, they will not be using these terminologies again. You'll be using earnings before tax, and interest in that order. But they all mean the same thing. The net profit before tax, is the same thing. Okay. So your profit before tax or your earnings before tax. So let me just clear it here so that it will not be confusing you guys, at least. Then tax. Tax of H is 14,000. And then tax of Y is 5,000. So when I add the two, 19,000. You can see that when I go to the expenses side, I did not bring the debenture interest of 1,000. Why? Because that 1,000 is what X paid to Y. So that one too is eliminated on the face of the book, this particular one. So this 1,000 here did not appear anymore. I get you the scenario. Good. So what I get here is what you call the profit after tax. Profit after tax. So I got my profit after tax of 19,000. And this 19,000 mathematically is equivalent to 200%. It's equivalent to what? 200%. Why am I saying it's equivalent to 200%? Because H here itself is 100% owned. S here, H is 80%, minority is 20%. So this is the another 100% here. So if I'm adding 100% here and 100% here, it means it is what? 200%. but I want that of only H. I want to know what is for only H. H has his own here 100, and then he has another 80 here. So if H own here is 100 and H is having 80 here, then it means that if I'm adding everything 100 here to H own here, then it means that I'm not reporting what is for only H. Somebody's 20 is inside, and the person's 20 which is inside is the minority. And so therefore, whenever you get the final profit here, you look for what we call the minority interest. You look for the minority interest. And so therefore, if H is owning 80% of S, then automatically it means that minority is also having 20% in S company. So what is the proportion of minority in S? In an attempt to find the minority proportion over here, you take the minority percentage holding. In this case, it is 20%. You go to the subsidiaries account. This is the subsidiary S. Take S after tax profit. That is S profit after tax. After everything, this is the profit the shareholders will be sharing. So H is entitled to 80% of this. S is entitled to 20% of this. So if it is S proportion that we want, then strike 20% of S on this. Then you know how much profit is accruing to S. And so therefore, if I want to know the minority proportion in this 200% over here, I will go and strike 20% on that profit. And that profit is the 5,000 you are seeing here. So I'll strike 20% on that profit, which will give me 1,000. And so therefore, if I subtract this 1,000 from the 19,000, I will be getting 18,000 Ghana cedis, which is equivalent to H proportion in the group. And this is basically how we consolidate the account, or this is how you are to consolidate the account of H, or that particular illustration that I've given you. This is how you are supposed to go by it. Very, very simple. If you have any question, you ask me, and then I will answer you. If you have any question, you ask me, I will gladly answer you, and then we go our way. So you see a question like this in an examination, you don't need more than 5 minutes to solve this particular question. It is very, very easy. What you are supposed to take note of is that, yes, fine, how much is the percentage holding? You take note of the percentage holding. What are the intra-group balances? So without the intra-group balances, all you need to do is to just add. Without the intra-group balances, all you need is to just add the financial statement, and then you go. Are you getting it? Nick, you are on floor. Let's hear you.
Saima,
yes.
Please go over from the other expenses for me, okay?
Okay, the other expenses.
Yes, please.
Okay. Now, after we got our profits of 41,000, we take other incomes of 1,000 out of it. Then we come to the other expenses. We were not given any additional information in connection with the other expenses, with the exception of the debenture interest. And so therefore, royalties of 4,000 still remains the same, because there is nothing being said about royalties in the footnote. And the other expenses we had here were only royalties. I get you the scenario. So that one you don't touch it. So you just bring it over there. Assuming there's royalties of 4,000 on H and there's royalties of 3,000 on Y, on S, you add the 4,000 and the 3,000, giving you 7,000 over here. And then you take it out from the 42,000 and then you go your way. But I was explaining that you can see that we had debenture interest over there of 1,000. But that debenture interest belongs to S, which he has paid to H. And that was the debenture interest they were talking about in the footnote over here, this particular one. That the debenture interest of H includes 1,000 received from S. So if H has a debenture interest of 2,000, and they are saying 1,000 is received from S, then 1,000 will not from here will not appear on the account. 1,000 from here too will not appear on the account. So basically, that is what we've done here for this particular illustration. Nick, are you okay now? Nick, are you okay now?
Yes, please.
Okay,
Thank
all
you.
right. Good. So this is basically the solution for this particular illustration. It is very, very easy, very, very simple. It's not difficult. The clue is that when you see the question, you look at the intragroup balances, And then what you have to have at the back of your mind is this particular one, where students normally get confused. This particular one, how to get this one is where most of you get confused. So we say you pick the profit after tax of the subsidiary and calculate the minority proportion on the profit after tax. That is what will give you the minority interest in this instance. I get you the scenario. So when you fail to get this principle, you will be failing to get this particular answer over here. So basically, that is what you are supposed to do. Let's move on to the next illustration, which is illustration 2. And in the illustration 2, there was something omitted in the question. So you pick your pen and paper, or you pick your pen and then you insert the omission over there so that when you are solving, you'll be able to understand. So just under the gross profit, there is an omission of administration expenses. So administration expenses of 50,000 has been omitted for acquirer, and administration expenses of 22,000 has been omitted for swallowed. So in the second question that I posted on the page, these two was omitted in the question. These two was omitted from the question. So you fix it in over there so that when you are learning, it will help you understand, so that you don't ask yourself, where from this particular one, where from this particular one. Is that right? Good. So when you study this particular illustration, there are two things. They have given you the financial statements, the income statement, and then they have given you the income surplus. They have given you the income statements, and then they have given you the income surplus account. Now, I want you to study the question very carefully. But my question to you now is that this particular aspect, this particular side of the question, here, this particular one of the question, I've posted it on the page already, and I've asked you to solve it. What I wanted you to do is to determine the goodwill. So with the illustration here, from here to here, we grab here. From here to here, just read the question from here to here and determine the goodwill. And determine the goodwill. Just the question from here to here. I'm just giving you the next 2 minutes. You can discuss among yourself, and then you tell me the goodwill. Then we continue.
No. This one. On my line right now, you have just like when I'm telling my story from.
The lady and few officer because I believe I need to check out. Well, I advise you what to do. The local lamp tailor. Hello. I don't want any.
Yeah, who have had who had it? Who was able to determine the goodwill?
That's one of them.
No, who had a goodwill?
Say my 5,000. I don't know if it's correct.
Had a goodwill of 5,000.
I don't know if it's correct.
Okay. Who else? Williams. Okay. So your book is 5,000 is correct. Let's go ahead and look at the solution. So, illustration 2. Now, you are being told that, let me go back to the question. Acquirer and Swallowed have the following profit and loss account for the year ended 31st December 2013. And Acquirer statement of profit and loss has been given here, Swallowed 2 has been given here. Then they gave you some additional information that Acquirer purchased 16,000 of the 20,000 issued 1 Ghana cedi Swallow shares in 2010 for 33,000. And the balance on Swallow's income surplus at that date was 15,000. And goodwill on consolidation is written off over 5 years. But I want you to put in your notes that we are assuming that goodwill has been fully written off. So let's start with that so that as time goes on, you'll be getting, and you get the understanding, you will now go to the 5 years written off. So for now, we are assuming that goodwill has been what? Fully written off. And then you are required to prepare the consolidated income statement for the group. So this is basically what we were given. Now, from the earlier lessons that we did in consolidation of balance sheet, we were not given the percentage holding. And I told you that without the percentage holding, you can't consolidate. So you must establish the parent subsidiary relationship. Now we're being told that Swallowed is having 20,000 shares. And the 20,000 shares Swallowed is having, Acquirer alone bought how many shares? 16,000 shares. Are you getting it? Swallowed is having 20,000 shares, and Acquirer bought 16,000 shares. So if he bought 16,000 shares from the 20,000 shares, then at the end of the day, how many percent, or in terms of percentage, how much is Acquirer getting? So the 16,000 divided by the 20,000 multiplied by 100 gives you 80%. 80%. And so therefore, Acquirer is having 80%, and minority will be having how many? 20%. So once you get your percentage holding, straight away you go and prepare your cost of what? Control. Now we're being told in the question that he bought the company for how much? 33,000. So the 33,000 is your investment. So you debit your cost of control account with 33,000. Then at the credit side, stated capital. So your stated capital is 80% of Swallowed stated capital, 20,000. So in the question, they told you that he has 20,000 shares, which one share is 1 cedi. So the 1 cedi multiplied by 20,000 shares give you 20,000 Ghana cedis stated capital. So 80% of that gives you 16,000 here. And they said on the day of acquisition, income surplus on swallowed account is 15,000. And so therefore, if acquirer is purchasing 80% in swallowed, then 80% of the 15,000 is 12,000. And so therefore, I told you that to know the value of the firm, we add the stated capital and surplus. So if you add the stated capital and surplus, it is going to give you 27,000. So if the value of swallowed firm is 27,000, 80%, 80% is 27,000. And acquirer is paying 33,000. Then it means that acquirer is paying something more than the value of the business. And what he is paying more than the value of the business is goodwill. And so therefore, goodwill on consolidation is 5,000. And that is the goodwill we are assuming that we are writing it off fully on the face of the account. So we are writing off goodwill fully on the face of the account. So this is how you prepare your cost of control account. Then from here, you prepare your consolidated profit and loss account. Consolidated profit and loss account. So when you look at the question, the turnover for acquirer is 600,000. So A plus S here means I'm adding acquirer and swallowed. I'm adding acquirer and swallowed. So 600 plus 300 gives me the 900 I'm having here. The cost of sales was 420 and 230. So I'll add the two, I'll get 650 Ghana cedis. So when I less the 650 from the 900, I'm getting 250,000 Ghana cedis. That is my gross profit. Then my distribution cost. So distribution cost for acquirer is 50,000, and then that of swallowed is 25,000. So I'll add the distribution cost 50,000 and 25,000. I'll get 75,000. And so therefore, I'll go ahead with my administrative expenses, the one I made you inserted, the one I said is omitted on the question. Acquirer is 50,000, swallowed is 20,000. So I'll add my administrative expenses of 22,000 and 50,000, and then I will get 72,000. 72,000. And so therefore, my operating profit is going to be 103,000. Why 103,000? Because I less my administrative costs and distribution costs from gross profit. So anytime you less administration and distribution costs from gross profit, you get what you call the operating profit, which others call it earnings, EBIT, earnings before interest and tax. Earnings before interest and tax. So if I take my interest from it, then I get what you call the EBT, my EBT. So when you see it somewhere, this is what it means. So earnings before interest and tax. It means that this profit, I am yet to subtract interest from it, interest payable from it. This profit here, it means that I am yet, this one means I'm yet to take profit and interest and tax from inside. This one means that tax has already been, interest has already been taken out from it. I am yet to take out tax. Then this one, profit after tax, this one means that tax has already been taken out from me. So that is what it all means over here. So my EBIT, my EBIT, my earnings before interest and tax is 103,000. Then I come to my interest payable. Now, in this question, you were not given the interest payable proportion. Take note. You were not given the interest payable proportion. So therefore, it means that we must look out for it and see that, okay, did acquirer invested in debentures of S? No, you were not told anything about investing in debenture of S. So assuming in the question they told you that, oh, acquirer has invested in 40% in debentures of S, or S has Swallowed has issued debentures and acquirer has invested in 40% in them, then it means that we will find 40% on S interest payable, and then we'll take it out from here. But in this question, we were not given anything of that sort. So once we're not given anything of that sort, it goes like that. So it means that the 8,000 and then the 3,000 will be added together, and the 8,000 and the 3,000 will be added together, and then we'll get how much? We'll get 11,000. 11,000 because acquirer has not invested in debentures of S. So take note. If you are learning, you come across this difference. Otherwise, that the first one, the interest payable, we subtracted S owned we subtracted 1 from 1, and this one we have not subtracted 1 from 1. The first one, you were categorically told that the interest payable from one is going to the other. That is why we took it out. But here, they have not mentioned anything about interest payable nor anything about debenture. So it means that acquirer has not invested in the debentures of Swallow. So you don't touch the interest. You don't do anything to the interest. You add them like that and then you put them there. But when it comes to the dividend, which constitutes our investment income, or which constitute portion of our investment income, you must take notes whether they tell you anything about that or not. You must work out for it. When you get to the dividend, whether you've been told anything about it or you have not been told anything about it, ladies and gentlemen, you must work out for it. Now, we know that, so let's go and look out for some workings. So dividend. Now we know that Swallowed declared how much dividend? Go to the income surplus. So that's why they gave you this particular income surplus. over here, this income support. That's why they gave you this one. You can see that the first illustration we did, they gave us only the profit and loss. Here, you were given the income surplus and then the profit and loss. When you look at the account, the dividend declared for the year for swallowed is 5,000. Take note. The dividend declared by swallowed for the year is 5,000. This is what swallowed is going to give to his shareholders. And among the shareholders, acquirer alone is owning 80%. Acquirer is having 80% of that investment. And so therefore, if acquirer is having 80% of that investment, then the dividend declared of 5,000 Ghana cedis. Therefore, acquirer is entitled to 80% of this 5,000. Who is working it out and giving us the answer? Who had it? How much? 80% of 5,000. How much are we getting?
4,000.
4,000. Good. Then minority will be 20%
1,000.
of 5,000. So minority is 1,000, right?
Yes.
Yeah.
Good. So therefore, the dividend declared by swallowed, this is the proportion in which the dividend will be shared. And so therefore, acquirer is supposed to receive dividend of 4,000. I get me. Acquirer is supposed to receive investment income of 4,000. Now, when you come to acquirer's account, have you seen investment income of 4,000 over here? Good. It means that this 4,000 here is the income he has received from swallowed. This 4,000 is the 4,000 we just work out here right now. So this one, you must work it out. If they don't tell you, you must be able to work it out so that you can eliminate it on the face of the account. So if you are unable to do these workings, to deduce how much he's supposed to be getting from the subsidiary, then you'll not be able to do the intra-group balances very well. So this 4,000 is what he got from the subsidiary. And so therefore, when we come to the face of the account and we are consolidating, the 4,000 will be nowhere to be found on the face of the account. You don't bring it over here. So you can see that this 4,002 has been eliminated from the account. Assuming this interest income here is 6,000, then when we come here, all what we'll do is that the interest income, the 6,000 minus the 4,000, like the way we did over here, that's what we'll do over here. We'll just subtract the 4,000 from the 6,000, then we put the remainder 2,000 over here. But here, the 4,000 he has received is purposely coming from what? Swallowed. So you eliminate all the 4,000 on the face of the account. So that is one thing I would like you to also take note of. Sometimes the question will not tell you all the details, and there are certain details you are supposed to take note of, or there are certain details you are supposed to take note of, or you are supposed to know and work it out by yourself. Okay, good. Now let's continue. So we get our profit before tax of 92,000, and then you tax So the tax for the two companies, acquirer is 30,000, swallowed is 8,000. So the two gives you 38,000. So you subtract the 38,000 from the 92,000. You get please be checking the figures if my answers are correct, because I did some editing over there so that you get correct answers. So check it and see. Yeah, hello. Yeah, hello. Yes, sir. No, please. I don't have it. I don't know their direction, unless my bishop. It's my bishop who can give you the actual direction to that, because he has worshipped there before. I don't think so. Unless you call him. As for me, I know my bishop will be the one who will be good. Yeah, he will be the best person. All right. Welcome. Sorry for the interruption. So you get your profit after tax of 54,000, and then this 2,400. Who can tell me how I got this 2,400?
The minus 20% of the profit after tax of S, which is 20,000.
So 20,000 is the profit after tax of X, right?
Yes, which is 12,000.
Hey, you said the profit after tax of S is 20,000.
No, it's 12,000.
Yeah.
No, it's 12,000.
It's 12,000.
Yes, it's 12,000.
So the 12,000. I getting it.
Yes.
Good. So you strike
Yeah.
the 20% on the 12,000. This on the profit after tax, which is also called the profit for the year. So look at it. You can be given the question. I getting it up to this side. Up to this side. You can be given a question up to this side, and then they will just give you the tax in the question. Then they will give you the income surplus. You should be able to do the rest, because the profit after tax is the same as the profit for the year. I get it. The profit after tax is the same as the profit for the year. So if you don't see profit after tax, you see profit for the year. So you should take notes. So that is how we got it. So the 20% of the 12,000 give you the 2,400. So when you subtract from it, you get 5,600. So that is how we got this particular one over there. And then from here, the next thing you do is to determine your retained earnings, or prepare your consolidated income surplus for the year. Your consolidated income surplus for the year. So I'll help you with that one. I think I'm here to do that one. So we say retained earnings brought forward. So the retained earnings brought forward, you add that of the two, let me do it simple for you so that at least let me do it this way. When we are going to the next one, I'll do it another way. So let me do it this way. So now when you go to the question, the proposed dividend of H, proposed dividend of H is 20,000. Have you seen it? So we are subtracting the proposed dividend of H of 20,000 from the profit after tax. So 51,600 minus the 20,000, we get 31,600. Then you bring your retained profits for this year, 56